Let's continue with our question. So we have already analyzed the question. So what we need to do at the moment is to make sure that we record this information in the accounting books as per the requirements. Okay, so now we will be opening what we call the general ledger account. By now, you know that handling client cash in legal practice is very crucial at the end of the day. In legal practice, it is crucial to manage clients' funds diligently. When the clients provide cash, it is essential to establish a clear and organized system to maintain the transparency and the comply with the ethical standards. So it's very much important in this profession to make sure that we do adhere to those rules. Okay, this involves using two different or distinct or special accounts. When you receive money, remember here we received money from the client, we received 120. So there are two distinct accounts which we are going to open. Namely, we've got the trust bank or the trust cash book. Then we have got what we call the trust creditor. When I said trust creditor, I was referring to this one. So this is the same as the trust creditor. So Mr. Vesta is the trust creditor. Okay, so these accounts are very crucial because we need to make sure that we separate those books. Okay, so because we are receiving cash from a client, we need to debit. Remember, we need to debit the bank because we are receiving the cash. I think by now we know the rules of accounting equation. Okay, debiting this account increases its balance, and since the trust bank is an asset, it represents an increase in the firm's assets. Okay, so trust bank is very crucial so that we can be able to store the cash that belongs to our clients. So by debiting this account, you are recognizing the increase in the cash assets held in the trusts or in the trust for the clients. So we know by now that we need to come to the debit side. Okay, so what I'm going to do, I'm going to go to the debit side and record the cash that we received from our client. So this cash was received from Vesta according to the information here. So we received 120 from Vesta. So the two accounts will be this cash, which is the bank, and Mr. Vesta, because we need to increase Mr. Vesta's account. So we need to go and increase the account, the bank account on the debit side based on the rules of accounting equation. I hope you understand. So I'm going to come here to the debit side. Okay, I'm going to put an amount of how much? Of 120. So I'm just going to say this T will stand for trust. Okay, so I just write T for trust. Even if you don't write, but as long as you came to the correct side, this will be regarded as correct. Okay, this is the first thing that we need to do. Remember, on the debit side is where we increase our assets. Okay, this is very much important. We increase our assets on the debit side and we decrease them on the credit side. This is very much important. Okay, so at the same time, because this money, as you can see, has been received from Vesta, so we must also go to the individual account for Vesta to make sure that we are keeping this money which belongs to Vesta. So immediately Vesta becomes our liability because we owe him. This money has been received in advance from Vesta. So it is important or crucial for us to make sure that we transfer to Vesta's account. And again, we must know the rules of account equation. But you can also apply what we call the double entry system, because here it comes from the debit. When it comes here, it will come to the credit. I hope it makes sense. So how are we going to write it on the credit? So you must just ask yourself, from which account did you take this 120? You took it from the trust cash book or trust bank account. So when I write here, I just have to show the other account where I took the amount from. Can you see now? I took it from what? From the trust bank. Can you see how do I record? This is the double entry system. And again, it shows that we have increased our liabilities. Remember, the liabilities increase on the credit side and they decrease on the debit side. Can you see now? So that's how to deal with the first entry of 120. Okay. And thereafter, if we go back to the question here, so we received the money and then immediately we were instructed to go and invest. So when you invest, it means we need to have a trust investment. Remember, this is according to section 86.4. So we need to go and invest the money. Again, the trust investment is an asset, like I said. So we must go and say, okay, because we said trust investment is an asset, under which side must we increase the asset? So obviously, this trust investment will increase on the credit side. Okay, so it will increase on the credit side. So it means we must go and take money from what? We must take money from the trust cash bank, bank, because obviously we need to go and invest it. So we must take money out. So when we take money out, it will come to the credit side. So I'm gonna make sure that I take this money out and invest it and open an investment account. So I'm just going to come here and say investment account like this, as you can see. Can you see now? It means I took this 120 out. Can you see now? It came in. Now I'm taking it out to the investment. Again, I must go and record under trust investment. I can apply a system called double entry system. Because here I recorded on the credit side, it means when I go to the trust investment, I must go to the opposite side. And again, the trust investment is an asset. Okay, so all the assets increase on the debit side. I hope it makes sense. So on the debit side here, I'm just going to say I took this money from the trust bank. So that's why now I've got a new asset in the form of what? Of investment. And then it means an asset increase on the debit side. That's why now we've got another asset, which is called what? The trust investment. And then you can see here, I took it from here to there. Remember, by taking this amount and investing it, it doesn't mean that you must also affect Mr. Vesta. No, Mr. Vesta, this money still belongs to Mr. Vesta. We still owe Mr. Vesta. It's just that we did invest on behalf of what? Of Mr. Vesta. So we're just trying to get that interest, but it doesn't change, it doesn't alter the account for Mr. Vesta as a trust creditor. So this one cannot be affected. The fact is we still owe him. It's just that the money that we owe him, we just took it for time being and invested. I hope it makes sense. Now, where do we go from here? Yes, we invested, but upon the maturity of the investment, we received an interest of 10,000. Remember, this interest is according to section 86.4, whereby the interest that we receive will be divided between the two parties, Mr. Vesta and Fidelity Fund. So now it means when we receive the interest, we need to go and open that interest just for the flow of this account. So here I've got an account, this interest. So interest is an income. So obviously when I receive this interest, I need to also show it in the books of accounts. Okay, so I need to receive the interest, and that interest obviously must go to what? To the trust bank account. So on the credit side, because income, I'm going to have what? An interest of how much? Of 10,000 that I received from the investment. So this interest must be taken to what? To the trust bank account. Okay, must be taken to the trust bank account. But before we do that, we need to make sure that we also show that this interest is divided into two. For now, I'm just going to leave it like this. Remember, an interest is an, let me write it down here. It's an income. Is an income. And then incomes increase on the credit. That's why I came here. But when we take it to the trust bank, I'm gonna wait. You can still take it as in 10,000, but obviously, I think if you can check some of your questions, then you normally get the investment together with the interest together. But even if you transfer them one by one, it's still okay. But I'm just gonna show you the way most examiners prefer it to be. Okay, so this shows that I received this interest. But this interest must be divided amongst the two. In other words, I must take this interest and divide amongst two people. So firstly, I'm going to give it to Sylvester, consist of Sylvester. So I'm taking it out. I'm taking this interest out. So I'm going to put it here to show that I'm taking this interest what? To Sylvester or Mr. Vesta. Okay? So I took the interest to Mr. Vesta. So why did I take 95%? Is because remember we're using section 86 for 95% goes to the client and the remainder will go to the Fidelity Fund or PFF. Okay, so again, I'm going to take the remaining part to the fund. Can you see now? So when you edit, it goes back to what? To 10,000. Can you see now? This is, I know sometimes they usually skip this step, but for me, I want to show everything so that I can see the flow. So when it comes to this, we call this contra account. But in your field, especially those who are dealing with, the attorneys, the lead, so they don't normally care about the way you put your contra account. As long as you put something acceptable, but it can be confusing because sometimes you struggle to link if you don't have this. For me to write this, it tells me about what will be the next step. By putting this trust bank account here, I know the next step is to take it to the trust bank account. By putting it here as Mr. Vesta, I know the next step is to take it to Mr. Vesta. So I know that by putting Fidelity Fund here, I know the next step is to take it to Fidelity Fund. So I try to make sure that I put everything in detail. I hope it makes sense. So before I forget, I'm going to take this 9,500 to Mr. Vesta and then take this to Fidelity. Okay, so I'm going to go to the Mr. Vesta. Obviously, I took it from the debit side. So, and I took it from this, as you can see, section 86 interest here. So I'm going to take it because here it is shown on the debit side. I'm going to go to Mr. Vesta and put it on the credit side. So can you see by putting everything in details, it tells you what will be the next step. So can you see I took it here and then it must go to what? To Mr. Vesta's account. And it makes sense because this money belongs to Mr. Vesta. So that's why I have to increase to show that Vesta at the moment has got 120 plus the 9,500 that he got from the interest. Can you see now? Of which this amount again is going to go to the bank account thereafter, but I'm going to show you thereafter once the better time. The same applies to this one. So this must go to the Fidelity. Where? Because he's on the debit side, it's going to go to the credit side. So it means we owe Fidelity how much? 500. I hope it makes sense. So meaning I'm going to then take that interest and then I'm going to put it here. Remember, the minute I put it here on the credit side, this shows that we owe. It's a liability. We owe. we owe this interest to this fidelity. Can you see now? So these things must make sense. Can you see by showing this interest account, it gives me that extra information so that I can be able to know what to do. Can you see now? Yes, remember here I'm just showing you that yes, this belongs to Vesta and this one belongs to Fidelity Fund. Remember, according to the information, we paid them. So in other words, these interests were paid to the relevant parties. They were paid to Mr. Vesta and again Fidelity Fund, but we are not yet paying. We're just showing that we are going to pay 9.5 at the later stage, and thereafter we're going to pay how much? 500. At the moment, it's not like we're paying. We received it, and then now it must be what? It must be taken to the relevant accounts. After doing that, we need to make sure that, remember, this trust investment has matured. So if it matures, obviously it means it must come back to what? It must come back to the trust bank account. So it means we must close this trust bank, this trust investment. So we must come to the opposite side. Okay, we must come to the opposite side to show that we are closing this investment because this investment has matured. So I will just come and put on the credit side to show that the investment has been what? Has been closed. Remember, on this side, like we said, the asset decreased there. So it means we don't have this investment anymore because it has what? Matured. So we say trust bank. So in other words, we're gonna take it to what? To the trust bank. We're getting that money back into the bank account. Okay. So what we're gonna do to the bank account and receive this 120 that we invested back, but it will come together with the interest. So the way I prefer to put it, I'm going to put it as the trust investment and the interest at the same time. Remember, I said even if you can put it as a separate entries, you won't lose marks. But I'm just going to put it the way you have been seeing it. So what I'm going to do, I'm going to say, okay, I'm getting back my investment, as you can see. I'm getting back my 120 plus the 10,000 that I invested. So the 10,000 includes both for, as you can see, the interest. Remember, it even makes sense. This is the 10,000 I'm talking about. That's why I wrote trust bank here, because it must go back to what? To the trust bank. So under the trust bank, I've got both 120 that I invested before together with the 10,000 that I gained. Can you see now? So here, I'm just going to put something here and say, and interest. For the sake of, understanding and interest. I think and I hope it makes sense. Can you see now? So it means we have got 130 that we got from the investment. The amount we invested together with the interest, can you see, is 130. If we did not get any interest, I'll only get 120. Okay, but I think even if you can just separate and say interest separately and say 120 and the interest of 10,000, they won't penalize you. But usually they prefer to put it like this. Can you see now? This is how you deal with the investment so far. But let's not forget, there's a statement that says all the beneficiaries were paid the interest due to them. Now it's time for us to pay them. Remember, if you go to Vesta, here we're just showing you that Vesta has got interest of 9.5. We owe Vesta 9.5, but they said we paid Vesta, so we must also pay. But remember, we can only get that cash from the trust bank account. So we need to pay this amount. Obviously, when I pay, I must come to the opposite side here, and I come and put it here, and I paid how much? I paid 9,500. In other words, I'm paying this interest. So that's why I say, can you see, it goes down. I paid it. In other words, I don't owe anything anymore when it comes to the interest. But by paying, where must I get this money from? I must get it from the trust bank. So under the trust bank, I'll go to the credit side because I put it on the debit side. And again, it makes sense because when I come here on the credit side, it means money went out. We paid. Can you see? It is part of this 10,000. So now we're paying it. So we're going to come here and pay Vesta on the credit side. Okay. I'm going to come here and say we pay Vesta how much? 9.5. So in other words, this 9.5 is part of what? Of 10,000. But we paid, as you can see, Vesta. And we also show that we paid here. Can you see now? This is the payment that I'm talking about. Remember, we must also pay what? We must also pay the interest, which belongs to what? Fidelity. Now, we owe a Fidelity Fund how much? 500. So we must also do the same and pay that. So how do we pay that? Obviously, we pay out of what? Of the trust bank. So we're going to make sure that we take money from the trust bank. So by doing that, it means we pay on the credit side here. Can you see now? We say trust bank because obviously this money must come from the trust bank. So can you see this is a liability? Remember the liabilities increase on the credit side and they decrease on the debit side. So by recording this 500 here, it means we paid this. Can you see now? So we paid. We don't owe them anymore, but we must get this money from the trust bank. Again, we must go to the trust bank account on the opposite side, which is credit side. And I'm going to say I paid what? Fidelity. So I'm going to go to the credit side and pay Fidelity. How much? 500. So if I come here, I'm going to say I paid Fidelity 500. So I must come and take, you see, when I pay, I take money out here. And then I paid what? I paid Fidelity 500. Can you see now? So if you see this 500 is part of 10,000. So the whole 10,000 has been paid, but part of it was paid to Mr. Vesta, our client, and part of it was paid to the legal practitioner Fidelity Fund. So this is how you need to deal with the figures. Okay? So I hope it makes sense. Just to double check, we can just double check if everything makes sense. So you can see we can start balancing here. Obviously, if you balance here, what is the biggest side? The biggest side is this one, or obviously here is going to be 250. See, and then here is going to be 250. I'm just trying to balance the account just to show you that if you balance this account, it will make sense. Can you see now? This is the 250. This is the total. So I can just, can you see now? Let me just put something like this. I'm balancing it. Never mind, I don't have the ruler. Can you see now? So obviously, the difference will be somewhere here. So let me do this so that it can make sense. Let me just cancel this and then shift everything down there so that I can have enough space. Let me put it here. Can you see now? So these are the totals, and then I must just change the color. So these totals, let me just say these are the totals. Can you see now? Now, this side is not the same as this side. So if I take this side and I minus this side, the difference when we balance in accounting, I think you know by now, we say balance carried down. So 250 minus 120 minus 130. So we're going to be left with what? We're going to be left with 120. Can you see we're still having 120 in the bank account? And then here we say balance product. This is how we balance, guys. If you don't know how to balance, you must tell me so that I can have a video about showing you how to balance. And then the balance here at the bottom is going to be 120. Can you see now? We only left with 120 because we did not perform. Remember, this is a court case. We did not perform anything. We didn't use this money. We just had additional 10,000 that we had. Can you see now? So we still have 120 because the 10,000 has been paid to the relevant parties. But if they did not tell us to pay, obviously the balance will be what? 250 now. Not 250, it's going to be something like 130. Yes. Now, the same here, we can check. We can do the same thing here. We can say, okay, what is the biggest side? Here, the biggest side is this one. What is this one? We can just say 120 plus, it's going to be 129, 500. And then here is going to be 129, 500. Okay. Can you see now? And then the difference is going to be there on the smaller side. We say balance. The difference is always called carried down, balance carried down. And then what is the difference between the two? The difference is going to be 120. Can you see the difference is going to be 120? Can you see now? It means Mr. Vesta's balance is still 120. Okay, still 120. So I'm just showing you this so that you can understand. So he still has 120 because we took this, we paid this in the form of cash. So it's his own money. So this one, if you close, obviously it's going to give you 0. Remember, the investment has been closed, and then this one again, you can just balance. It's just been closed. So this is the 10,000, and this is 10,000. Okay, so it means this one has been closed already, so you don't have to worry because it has been closed, remember. And then the same applies to this one. If you want to close it, it's like 500. 500. So this is how to deal with the interest on investments, or the investment whereby section 86.4 is used. Remember, here you have been instructed by the client to go and invest. Can you see now? This is what I said. The client instructs the attorney or the firm to invest in an interest-bearing account or a separate trust account. 5% of the earned interest is paid to the fidelity, and 95%. So in the next video, I'm going to show you how to deal with the section 86.3, whereby the firm decides to invest. No one instructs the firm decides to invest. But remember, when the client, the attorney decides to invest, that amount of money is for the benefit of the fidelity fund. Okay, so the firm is not compelled by law to invest. It's just a decision. So that money belongs to the fidelity fund. But I'm still going to show you that one. So I hope everything makes sense, and make sure that you study hard, and I think everything's going to be okay. Thank you very much, ladies and gentlemen.